All right, guys, we got my friend Marc Oshiro from Honolulu, Hawaii. We're going to let him introduce himself and talk about what he's up to and why we got him on the show today.
Oh, thanks, Andy. I'm not really sure why you brought me on, but I'm here
Oh,
hopefully.
don't be too humble, Marc.
Marc Oshiro, born and raised Honolulu, Hawaii. I'm a firefighter, realtor, and out-of-state investor currently. And I have 14 single-family homes in Pittsburgh. I've invested in one syndication so far, and I also have a small single tenant commercial unit in Honolulu, Hawaii as a partnership.
Oh, wow, I didn't know that. All right. Why don't you tell us about your new project in the catchy name you came up with?
Since I'm a firefighter and the big movement now is the financially independent retire early community. Actually, I have to give credit to where credit is due. Another YouTube person, Millennial Mike, who's actually a police officer in SWAT. He actually kind of came up with the name. So I go by the Financial Firefighter on YouTube, Instagram, Twitter. But you can find me all over those platforms and just trying to build a brand right now and definitely help others find the path to financial freedom through real estate and out-of-state investing.
How does an accounting and finance major become a firefighter?
Well, I went through the process of following going to school, trying to find a secure job, get a good education and work your 40 years. I definitely didn't really have a clear path heading into college. I spoke to a lot. My brother's older; he's 7 years older. A lot of his friends were in accounting and business, and they said, you know what, just if you're not sure what you want to do yet, kind of just go into the accounting path because that kind of covers everything. It's kind of general for business, and if you can understand the books, then you'll have a pretty good understanding of how business operates. So that's kind of what put me down the accounting path. And I to this day I've never used my degree. I was doing odd, retail jobs, management jobs after college, and I kind of found the path to becoming a first responder. And that became my goal and my passion, and didn't wasn't as smooth as I thought it was going to be. I didn't get into the city and county, the Honolulu Fire Department, my first few attempts. So I went through, we have a program here at HCC, which is a fire science program. So I ended up starting my fire career with the Federal Fire Department, which is the military bases. And that's where I started for the first few years. And then I continued to try and get over to the city and county. And that's where I've been for the past 15 years. And I definitely was headed down the work 25 years, for my pension and get the wonderful benefits that it offers. And yeah.
So what motivated you to go down the rabbit hole of acquiring 14 properties in Pittsburgh?
So it kind of just snowballed on me. So I had a condo which I was renting out from maybe 2010. And so I actually did kind of actually like a untraditional type of house act now that I look back on it. It wasn't planned and it was some unfortunate situations. However, I had a condo which I was living in, and unfortunately my dad had a stroke my first day in the city and county fire department. So he's been pretty much paralyzed on the right side since then, but he figures everything out. He's amazing. He still drives. Everything is adapted for his left hand. The pedals on the left side. He goes to the gym. He's the one that actually drives my mom around. My mom doesn't even drive already. But anyway, but at that time it was kind of a I guess an unfortunate situation. And my parents were getting older, and at that time when my dad first had the stroke, he wasn't driving and whatnot. So I actually moved back home to help out with doctor's appointments and help her out, whatever I could. So I actually was renting out my place when I moved back home. So actually, I basically eliminated my living expense. And looking at it now, I mean, that's kind of what a house hack would be, reduce your expenses. So that happened, and then I moved into a single family home in 2015, and I kept the condo, but I never considered myself a landlord. I just thought that was kind of the stepping stone, the progression you do. You start off smaller and then you move into a single family home. And it didn't really start until 2021 during COVID. I saw people losing their jobs and being laid off. And fortunately, I'm a first responder and I was still able to work, but it just made me evaluate things and look at how risky I was being with my financial situation. And I hate to bring this story up on all my interviews and podcasts and whatnot, but me and my son's mom split up during the lockdowns. Lockdowns was rough for a lot of people. However, that kind of gave me the opportunity, because my friend was investing in Pittsburgh at that time, and he was always putting it in my ear. And since me and my son's mom split up, I had a lot more time on my hands. I had equity in my properties, so I said, you know what, I'm gonna kind of look into this a little further. And my friend, he of most of us do in the beginning of our real estate journey, we make a lot of mistakes and we learn. And
Oh yeah.
he definitely made a lot of mistakes, so it actually kind of made the process easier for me. Like, I felt like I'm going to piggyback off of your system and the mistakes you made. And it made me feel more comfortable, starting this process. And it just snowballed on me. What was supposed to be a slow process of kind of do one and see how it goes. I just started looking at the numbers and really started going on the rabbit hole. And I looked at it and I'm like, this makes way more sense than your 401k and your deferred comp and all these other traditional retirement plans that a lot of people are kind of believed to think is the best course of action for retirement. And I just went all in and I decided that I'm gonna take everything out of my retirement accounts and get it into hard assets and get them into properties and go from there. And that's how I acquired 14 properties. Oh, and in the process, I did 1031 my condo into properties, because as a lot of people know, in Hawaii, our prices are kind of high. And I wasn't really cash flowing positive, even renting it out. So I decided, I'm gonna turn this into some other assets that is generating more income for me.
A lot of good nuggets here, Mark. It's just funny. It's such a constant theme with you, always helping everybody, right? Being a first responder, helping your parents out, and now you're helping, fledgling investors, new investors out. You're paying it forward, right? I mean, your friend was your mentor. That's a wonderful thing. What are the main themes that you're trying to get across um, to younger investors or newer investors when they're entering the real estate game? What are the things you can teach them?
I can just teach them all the mistakes that I've made, and hopefully they don't make those same mistakes. So I'm definitely just trying to tell my story is kind of what it is, and just letting them know that there's other options out there. Don't fall into the trap of believing that your pension is always going to be there, or even that that's the best plan for retirement. Because like anybody looks at now, like in these inflationary times where everything is going up in costs and expenses, the pension is kind of a fixed payment. And people are, you don't really realize that at the time when you're planning your retirement. You think, I'm going to get this much from my pension, and then now you're on a fixed income, and when everything else is getting more expensive, are you going to go back to work, or are you going to not enjoy retirement as much as you thought you were? So it's definitely just trying to change the mindset of the younger guys, and just anybody that wants to listen. And especially in Hawaii, we kind of fall into this trap that we kind of live in a bubble, I'd hate to say, and we're not really aware of what's going on in we call it the mainland, in the United States. And we don't realize that there's pockets there that rentals or real estate, you can generate income, and that's how you build your wealth. And we just look around here and we see that everything looks like it's $1 million to buy a home, and you don't realize that there's other opportunities out there. And a lot of it is, a lot of people, they're trying to save 20% down to purchase a home. And if it's $1 million home, to
That's
get
a lot. Yeah.
20%, it takes quite a while. And then when you actually get that amount, the property's probably appreciated another 10 to 15%. So you're still chasing that down payment. So it's just definitely trying to help people's mindset and realize that there's other opportunities out there. There's stocks and crypto and other, commercial real estate, and there's different things. And for me, for right now, I prefer single family homes, but there's tons of things out there. And one of the biggest things is this networking and finding people that are doing the things that interest you. And like, that's how we met at a mastermind, and we met at some meetups, and that's what it's about. And the one thing I want to tell people is, everyone that I've met, I mean, everyone is just super helpful, and there's so much abundance out there, and everybody's willing to share knowledge and help each other. Just like you've been amazing. Every time I run into you, man, it's like I've known you for like, our whole life, and we're just talking and chatting and passing on information.
Well, we practically have known each other. We have all the
Yeah.
same, a lot of the
Yeah.
same childhood friends. And I mean, I grew up in Waialaiki, you grew up Hawaii Kai. It's, around this, we're within probably a year or two apart of each other. So we probably have bumped into each other many times in our lives. It's a small
Yeah.
island. Um, in looking at single family homes, the pro for a single family home is going to be relative simplicity, and the 30-year loan is a great thing. I mean, I love it. I love the 30-year fixed loan. Not so much at today's interest rates, but boy, did I really love it at lower interest rates. But what are the cons that people shouldn't be afraid of, but need to consider when they're looking at, scaling up to past, one or two single family homes?
So definitely, I want to be straight, honest, and single family homes, or investing in rentals is not as passive and easy as people make it out to be. Everybody on YouTube and social media is like, oh, you just get a rental property and cash flow, and you're gonna be on your way to financial freedom. And it's definitely not like that. I mean, it's definitely rewarding. However, in the beginning, it definitely takes a little bit of time to get your feet wet and kind of get things stabilized, and just realize that problems are going to happen. And however, if you're in it for a certain amount of years, you're gonna end up on
Oh yeah.
top. And definitely the hardest part, I would say, is what in the beginning for me, it was trying, like you're saying, trying to scale. And what I found out is there's just this whole different lending world out there, that same thing we're not aware of growing up. Like I always tell people, I just thought you're supposed to go to your neighborhood bank and walk in with your W-2 and your tax returns, and that's how you get a loan for a property. And what I found out was there's a real estate world, and there's a whole separate lending world. There's all to itself. And once you get into that lending world, it opens up so many opportunities. And for me, I went down the rabbit hole, and I found out about DSCR type loans, which are more asset based, and you don't really have to show any income or tax returns. Is based off of the asset. And for me, that definitely helped me scale. And then for as far as scaling after that, I definitely feel like, depends what your goals are. I mean, some people, they only want maybe 4 rental properties, and that's what their goal is, and that's fine. And that could be life-changing already.
Oh yes.
However, other people that want to scale a lot bigger, and definitely that's where you start looking into multifamily operations or even syndications. And that's something I'm probably considering down the road, as far as multifamily type things. But that's a little more, once I kind of get a little more of my portfolio stabilized and I have better reserves. I'll admit I didn't plan well with reserves, and that'll be something that, I try to reinforce with new investors. Hey, make sure you plan well for reserves, and I didn't do a good job of that, and that probably slowed down my progress a lot in the beginning. But it also made me resourceful. I'd have to admit, it makes you get creative as far as how you're going to come up with capital or whatnot. So it's all about solving problems. You're always going to encounter problems, and it just comes down to how you're going to solve them. And that's also why networking is important, because there's people that have done it before and made those mistakes, and you can reach out to them and get ideas. But also, like I mentioned earlier, I am in one syndication with simple passive cash flow, and I gotta admit, I like the hands-off approach to it. I mean, I like it. I like the idea of the syndications where you do a lot of work in the beginning, looking at the project, running the numbers, seeing if it makes sense. But once you wire that money,
That's it.
you're very passive after that, and that's one of the great things about it. So I definitely see that as the end game, or for even people that have high net worth or busy jobs. I mean, I know I'm a firefighter, and we do have kind of a lot of downtime. I do have, the single family homes, as much of a headache as they are, I do enjoy it still yet. So that's part of why I kind of like it. But syndication is wonderful, and I definitely see that as a great end game, or kind of balancing out your portfolio.
Yeah, because for me, I was doing this back in 2010, and yeah, I kind of ran the course of, okay, I've been there, done that, invest, and unlike you, I wasn't smart. I probably should have just stuck to my one city and have my network. And we got up to 9 states, and it got to the point where, I mean, I couldn't remember the addresses for places. And you're looking at your insurance statement, going online, and you got multiple bills for your insurance, and you're trying to make sure you got all your 1099s, and you're going to an accountant, and tax return is getting thicker and thicker. And investments better than others, and it started being, oh my gosh, I'm creating a second job for myself. The point of what I was doing was, my family runs a family business that's pretty demanding, and it was, this is supposed to be just a side hobby, a backup plan, better than stocks, just money off to the side, supposed to be passive. And I can only imagine with 14 properties, all you need to have is one problem a month, one problem, and get every single month you'd have a problem with all the properties, right? And some problems are smaller than others, right? I mean, it's not the end of the world if you have a leaky toilet. You just fix it and you pay the plumber, and that's that, right? But yeah, that is the
Yeah.
of most investors would like to get into notes or LPs when they get a little long in the tooth and gray, like myself, and they start want to play golf and spend time with the grandkids.
No, exactly. Yeah, like I said, that's definitely the end game, and your hands off, and you just, you're getting those monthly or quarterly payments, and then the big, hopefully, equity payouts at the
Yeah.
end, and that's how you accelerate your net worth, and your how much money. And that's another thing I want to mention is, it's a whole mindset thing. And what I've found out is, especially in the mastermind, and meeting up with a lot of people that do syndications or higher net worth individuals, it's all about that spread, and 1% here and 1% there, and it all adds up. I mean, a lot of times I'm victim to it too. Like, I think a 1% return is nothing. But if you have like 1% here, 1% there, 1% here, and it's all, now it's off of $1 million, now it adds up to, a significant amount of return. And that's the one thing you got to get your mindset, is how you're making your money work for you, leveraging it off of different places, like putting your money in one place, and then borrowing from that to put it on another return here. And then you just keep having your money work for itself. And that's kind of the biggest thing I've picked up in all of this, is these people that are way ahead of me, that's the concept that they understand. It's all about making your money continuously work and grow, and that's super important.
Why don't you go into the concept of depreciation for a lot of our audience? Because a lot of my audience, when you talk to people that are newer to real estate, they won't grasp that a 4% treasury bond, like just let's call it a 4% bond and a 4% yield on a house aren't necessarily the same thing. If you're comparing, especially a stock with a dividend, and outside of an IRA, if it's just held in a regular account, because they don't really understand how powerful depreciation is. Why don't you uh, let the audience understand about that?
Yeah, so that's kind of that I kind of come up with the exact term, but it's like that hidden it's your property is depreciating when it's actually appreciating, and it's kind of this made up expense in a way, and that's the tax code is written for investors because they want to kind of incentivize landlords to provide housing and safe housing for people. So depreciation is just another kind of basically takes away from your passive income or your income on your rental income. So you basically hopefully are not necessarily showing a loss, but you're basically not showing any income to pay taxes on. So that's what makes real estate or rental properties multifaceted, because like you're talking about the treasury bills and the yield, a lot of times people are just looking at the cash flow and comparing that to the yield on the treasury bonds, but they're not looking at the principal pay down and the appreciation, and like you're saying, the depreciation that you can use on your taxes. So you're actually earning money almost in almost four ways on your rental or real estate property. And the good thing about it is, you get 100% of the benefits when you possibly only putting in maybe 20% of your own money, but now you're getting 100% of the benefits off of the asset. And depreciation is just one of those hidden things that a lot of people don't really think about, but basically it's just reduced, like they always say, it's not really how much money you make, it's how much money you actually keep.
Yeah.
And that's what the depreciation helps with, is basically reducing your taxes through, I believe it's 27 and a half years. They depreciate the property and they take that off of your rental income. And it's amazing. I mean, it's something that like a lot of people just don't realize is available to them. And they just think of cash flow, but they don't realize there's other ways to benefit from real estate.
One of the things that I wish I had done sooner that I didn't know about until just the last few years, that 10 years ago when I had bought the property, would have qualified for it back then. Nobody told me that you could do a cost seg study. Why don't you tell our audience a little bit what a cost seg study and why it's so attractive?
Well, cost segregation is basically almost like front loading your depreciation. And instead of basing it off of the 27 and a half years, you have someone do a study on the property, and I believe it's 5, 7, and 15. They break down the components of the property, and certain things are going to depreciate over a different time frame. And now you can use that depreciation and front load it in the beginning to take extra losses in the beginning of your lifespan of the property. And it basically, you're going to use that as a way to reduce your income. And for years after that, you can take it off of other, if you get a certain amount of income above that, so you can use it in further years after that. The only thing though, I believe was it the end of the January 2023, you had to do the study, but
Yeah,
it is going to be,
to get the bonus. Yeah.
yeah.
It's funny
So it's going
because some people will naively say to me, but you're going to have to pay it back eventually, or you're going to get hit with the 25% recapture. And I always have to remind them the time value of money. The sooner I have my money to reinvest and reinvest over a period, I'm making more money. And then 25% recapture, great. That's probably lower than most people's tax brackets if they're investing in real estate. So, cost segregation is something that when you're looking at a property, like for me, it's not good for me to buy four $100,000 properties. I'm better off buying one $400,000 property because it's big enough now to justify the cost seg study, the fees. You're not really going to do a cost seg study on $100,000 house. Now, that's not to say someone shouldn't buy the $100,000 house. If that's what you can afford to buy, that's the starter home. That's the way you kick off your investment journey. But that's the thing is when I'm always trying to talk to people, when you see an investor at the stage they're at, they probably were stages prior or they're stages they want to get to. So when you're buying, everyone loves that term, which is always a misnomer to me. You know where I'm going with that is, the turnkey house, right? Turnkeys are great. That there's nothing wrong with them, but at some point of number of turnkeys, you're probably going to want to scale up and 1031 out and maybe get one or two or three, depending on how many turnkeys you had, because you're going to start losing out on the benefits of some of the tax advantages. Also, just certain houses, certain regions, you'll get better lending terms, correct?
Exactly. Yeah. I mean, that's another thing that I always try to reinforce to people is, don't compare your year one to someone else's year 10. I mean,
Oh, yes.
like you're saying, there's a you want to just get started, get your foot in the door, but that's going to allow you to scale. Like you're saying, you can start with a cheaper one or a lower price point, but then you're going to leverage that in a few years into a bigger asset, and that's kind of just how you continue to scale the portfolio. But that's the one thing is definitely don't get caught up with. I mean, you want to learn from other people what other people are doing, but you just don't compare their results to when you start, because they like I said, I mean, everybody, we've all made mistakes.
Oh, yeah.
We're all learning. I mean, we've all done it, and that's definitely why I'm trying to help people, let them know the mistakes that I've made, because I've learned from people like you and other people that have podcasts and YouTube channels. They talk about the mistakes and their progress. And I feel like that's just one way to learn. And you just, you can, I guess you can just reach out to these people, and a lot of them, you'll be surprised. They'll comment back or they'll reply, and, they'll give you their insight on what they did and whatnot. And it just helps you along the process. And like you said, definitely. But I think the one thing that it is also, look ahead. Like you're saying, you can start with a turnkey or start with a easier entry point, but also kind of visualize what your plan is going to be as far as, are you gonna scale into Airbnb? Maybe are you going to scale into syndications? Are you going to scale into multifamily? But that's also why I love real estate is there's so many ways to diversify in this asset class. A lot of people talk about trying to diversify your portfolio, and I feel like for me, I don't have the bandwidth to be doing stocks and doing real estate and doing crypto. There's only so much I can focus on, and for me, I love real estate, but I also feel you can diversify so much just in that one asset class, and that's what I love about it.
One of the things that people will start getting used to once they read a little more about real estate, and I'm always telling people, be really careful about the magazines and the pundits and the top 10 lists that just annoy the heck out of me, because you don't really necessarily need to be in the hot city. Now, great, it's fun to go to the party and everyone's having a beer and you're bragging about, I'm invested in this city and it was top it was in the top 5 fastest growing cities. And then I always have to remind that person, when the eventual downturn comes, your top 5 city in the boom, pretty good chance you're going to be in the top 5, downward spiral. Tell me about why Pittsburgh was attractive to you.
So exactly like your point is saying is, there's a lot of great markets out there. And, I think that's kind of what holds a lot of people up is they're, like you're saying, they're trying to find that perfect market. I want the number one or the best appreciating market. And I hate to say it, but Pittsburgh, I didn't use like this whole calculated process of I broke down numbers. To me, it was the fact that I had somebody to piggyback off of. And I think that's what's super important is someone or having boots on the ground or having a a family member that lives there, or an old college buddy, or just someone. And I'm stealing this from, I don't know if you know your viewers probably, but Michael Zuber from One Rental at a Time.
Big fan of
His
Michael Zuber's. Big fan. He does
yeah,
outstanding work. Outstanding
he
work.
I love his content, but what he always says is have someone that will attend your funeral, that that lives in that area basically. So I think that's more of why Pittsburgh. I mean, I did look into Pittsburgh, and I definitely felt that there was a lot of opportunities there. There's a lot of tech and health industry moving to that market. So it's a little kind of under the radar. But for me, the biggest thing was that I had a friend investing there, and he made a lot of mistakes. So he kind of had a team in place. So I was piggybacking off of his system. And for me, that was kind of the biggest decision on why I chose Pittsburgh.
That's a really important point that you're making, Mark, is, if you follow someone like Mike Zuber, he's often going to talk about, I'd rather have for the property management, I'd rather have a really good property manager in a okay linear market. A linear market doesn't mean flat, it just means kind of going with the normal rate of the country or inflation. It doesn't have to be the hottest city in the world. Just a good management team. I'd much rather have a good management team in a linear city than a terrible management team, terrible broker, no connections. You're flying blind, especially as remote investors. Especially being guys in Hawaii investing in the continental United States. If you don't have somebody you trust and you don't have some connection to that city that gives you some kind of competitive, durable advantage, you're kind of just guessing. And I mean, at that point, you're really speculating. So I would always involve, increase every like think about your network, think about who you know, and where you have family friends, or you got a college friend, or some connection with the city. Like for you, your friend is a great example. What was the last few pieces of advice you'd want to give to like people that are looking to either buy their first home, or that maybe they're trying to get to that second or third stage and they're just kind of a little stuck?
I would say just network, and be around people that are doing or are where you want to be, and just ask questions. I mean, like I mentioned earlier, everyone is super helpful, and there's just a bunch of abundance, and people are just willing to give information and help others. That's what I've noticed. Like no one is here like trying to keep secrets, or no one is like, I mean, there's deals to go around, and everyone is just trying to help everyone get ahead. And I think that the biggest thing for me is just realize that you have to kind of, I hate to say it, but you have to just change your mindset just a little bit. Just think a little differently. I mean, we've all kind of been led to believe that finding that safe, secure job is the best way to plan for your retirement, and that's the only path that's out there. But just realize that there's tons of other opportunities out there, and you could still work your 9 to 5, or like I said, you could be in the fire service and love it. You could want, you could love doing 25 years and getting your full pension and everything. However, just realize that there's other ways to also just give you more enjoyment during retirement, or just plan better for your retirement. And that's kind of just what it is just changing your mindset and realizing that there's so much opportunities out there that people aren't aware of, and just be around like awesome content creators like yourself. I mean, like every time I meet you, I learn something. I mean,
I'm a
it's amazing.
modest. Mark, I'm learning from you, man. I don't, 14 houses. God bless your soul. I don't want to do that ever again. I have a lot of respect for what you do.
Well, I like I said, this being honest, transparent, just telling everyone it's not like everyone says, it's not easy. It's
this is
not
not
fast.
easy.
It
I
does take
can definitely
time.
vouch for this. I mean, once you cross the Rubicon of 2 or 3, once you go 4 and you start getting higher, it can get overwhelming if you don't have systems in place. if you're not organized, if you don't take this seriously, I mean, you are creating, in a sense, a side hustle for yourself. I wouldn't quite call it another job, but I mean, it's a serious, it's a serious endeavor. It's a little more than a hobby investing. You're investing in yourself at that point.
The social media side is harder though. The social media is more work than managing or taking care of 14 property. Trying to get all this content out there and building a brand. That's a lot of work. So all these people out there like you that have channels and podcasts, and I give you guys props. I mean, it's a lot of work doing this stuff.
It's funny. I've never looked at it as work though, because to me the podcast is just really for giving back, meeting people and having fun. It's never been a work issue for me. It's kind of funny. I just enjoy it. Kind of like you, I enjoy giving back because I've been unbelievably blessed with wonderful mentors. So it'd be completely disingenuous of me not to try to give back to the community. Um, you know, our generation is, I remember a time before internet, I mean, I'm sure there's some kids watching this going, man, this guy's really old. He lived before the internet. There really was a time, before the internet. And as much as I love, YouTube shorts and TikToks and Instagrams and all these social media outlets, what are the books that you were reading when you first started out or that you might be reading now for people that actually don't mind a little bit of pen and ink and learning the old-fashioned way?
Well, that's another one of my jokes, or what I tell everyone is that I probably haven't read books since I graduated college. Like, I mean, I probably, didn't read much since then, just, internet articles and whatnot. But ever since I got into real estate, I mean, I'm constantly reading books. I'm constantly trying to educate myself. And that's also how I know that this is something I'm passionate about. And part of it was whenever Rich Dad Poor Dad first came out, my uncle, so I think this might have been in the late 90s or early 2000s,
Yeah, sounds right.
I believe. But my uncle was in real estate back then, and he gave all the nephews and nieces this book to read. And I read it and it just didn't make any sense to me. I was just like, what do you mean my home is not an asset? I've always been led to believe that, you buy a home and it's an asset. And I just thought it was the dumbest book. I was like, this makes no sense at all. And
That's
then I reread it, a couple of years ago, and now I'm just like, oh man, if I just listened to what this book told me, 20 something years ago, I mean, I'd be retired by now. But that's definitely, like I said, the mindset shift and just, looking at things from a different perspective. And now when I read the book, I'm just like, this makes so much sense. And it's it's just something we're not taught, when we're growing up. And that's probably the one book that, and everybody talks about that book, but that definitely, I've read it at a point where it never made sense to me. And now I've read it and it just totally, completely makes everything a lot clearer. And another book that I read, actually, that's what I grabbed. I think
Oh
I
wow.
really love The Secrets of the Millionaire Mind.
Mhm.
Yeah, by Harv Eckert. I love that book. To me, it just totally reinforces how we kind of almost are pushed down this path of kind of what we're led to believe money is about, and how we're supposed to look at money, and almost like how we're taught that money is evil and greedy if you're trying to get money, when that's not
Mm.
really the case, right? I mean, no, I mean, for most people, if they're a good individual and they get a lot of money, they're still a good individual and they're probably going to do more good with it. Whereas, unfortunately, if you're a bad person and you get money, I mean, you're probably still going to be a bad person. A lot of times money doesn't change people. I mean, a lot of times you put more money in a good person's hand, they're going to do good things with it, and a lot of good's going to come from it. But that book definitely helped me realize that, you know, trying to reach financial freedom too is not wrong, or it's not this evil thing, that you don't have to be greedy to be trying to reach financial freedom. And everybody's financial freedom is different. Some
Mhm.
people it could be just having a little bit extra towards their latter years in retirement. And There's others that, like myself, who's trying to retire early, and that's my goal. And but everybody has different levels of financial freedom. But it's just kind of realize that you can take a different path to get there, and a quicker path than the path that we were led to believe, growing up.
That's just wonderful, Mark, because it really is, it's really true. Everybody could benefit by learning more and investing a little more carefully with their money. That new car that you don't necessarily need, or I'm all for vacations and experiences, but you know, as an America, as a society, and we won't get too political or overly philosophical, but the people that are spending more than they make or living on their credit cards, they're playing a very dangerous game that more prudent, conservative people aren't going to play. And you fast forward, it explains how does like a school teacher live in an, have a better retirement at the end of a life than some highly paid white collar professional. Well, he was a surgeon, but he spent every cent he had, and he was maxed out in the credit card. And the other guy, lived in the same house his whole time. He didn't keep up with the Joneses. He didn't have the lifestyle creep. Lived in a nice enough house, never bought, crazy expensive cars, just bought cars that worked and drove them a little longer. And, flash forward, now they're old men, and one guy's got nothing to show for 40 years of work, and another guy's got a legacy for his grandkids, and he's vacationing, and he sleeps good at night. And it's just amazing. I've seen it in my personal life how many times I've known people that have made incredible amounts of money that are broke. And then I've seen people from, frankly, relatively very humble educational or professional backgrounds that have amassed, pretty significant wealth. And oddly enough, some of those people, it didn't really necessarily change their life, but it just let them sleep better at night. And that's all they really wanted. And they, for like us, being fathers, like for me, a lot of times it's more about legacy. It's about leaving something for my son, you know, both financially and mindset and education, that God forbid I get hit by a bus tomorrow, that my son understands not to just max out the credit card and pay the minimum. I need to know that when I go to bed, that like I've at least raised him right. It'd be nice to leave him a couple houses so that, he doesn't stay on a terrible job. Like it's not that I want my son to be some trust fund kid and not work and be a loafer. But like for your son, I don't know how old your son is, but you'd want him to do what he's excited about doing, not working for a paycheck and, oh God, I don't want to get up this morning. I got to go to work, but I got bills to pay, and the BMW in the garage, it's real expensive. I got to make that monthly nut on that payment. We want our families to go well beyond that. Real estate to me is that's the place to be.
Oh yeah.
It's the place to be. It's the most tax advantaged asset. It's the best form of collateral for debt. It's a time trusted asset. It's got a very long track record. And frankly, you don't need to be a PhD to do well in this. I'm not
Oh,
good. I have friends
I'm
that do very well in trading cryptos and derivatives and futures, and they're brainiacs and high IQs. And I'm like, guys, look, I don't have that kind of IQ power, but I do pretty well in real estate, because you just put in the work and you do everything right and you're patient, it compounds and it snowballs, and over a long period of time, it does well. So, Mark, why don't you tell the audience how they can get a hold of you if they have questions or they want to learn more?
Well, I'm all over social media, so YouTube, Instagram, Facebook, Twitter. You can just look me up, Financial Firefighter. But I do want to kind of blame you for getting me sucked into LinkedIn. So I was never much on there, but now I'm headed down that path. I'm still trying to navigate my way around there. But I don't even know. I think that one I might just be Marc Oshiro. I don't know if
Oh,
I
okay.
don't.
Yeah,
But
I believe you're Marc Oshiro. Yes.
yeah, I'm still trying to figure that avenue out, but I blame you because you're telling me how wonderful, and it's amazing though. There's awesome content there too. But yeah, Financial Firefighter on Instagram, YouTube. I'm gonna get you on my channel
Yeah.
also after this.
And it's a cartoon character, right? It's not some of your icons are not the Marc Oshiro we're seeing now. It's the caricature of you in a firefighter
Yes,
suit, right?
Yes. Yeah.
That's not to scale, correct?
No, of course not. No, no. Well, maybe the head size might be, but
Yes. All right, man. It's been so much fun on, we'll have you on again and we can maybe get, a little more into the advanced topics. Tonight was really, to benefit people looking for their first time, investing or maybe, going, catching up to that second or third home. Thank you so much, Mark. I'm really excited about this because it's so obvious the passion you have for this. And there's a lot of people that really need that spark or that boost or someone that they resonate and connect with. Like for you, you're a big fan of our buddy One Rental at a Time. And because you probably connect with him on a personal level, correct? So
oh yeah.
I'm hoping someone's watching this. They've been thinking about it, they've been wondering, and now they're like, wait, I like Mark. He seems like a guy I'd hang out with. I can do this. And I would encourage them definitely reach out to Mark and ask him questions. I know him in real life. He's a great guy. What you see is what you get. This is the real Mark. This is not an act.
Thanks. Thanks for having me on, man. This has been a
Oh man,
lot
this
of
is
fun.
fun. This is good fun. All right, Mark. Have a good night, man.
You too. Bye.